Most beginners enter the market searching for a quick winner. They chase hype, follow social media tips, and buy whatever stock everyone is talking about. But successful investing often begins with something much less exciting, a simple plan. Step 1. Stop chasing hype. Before buying a stock, ask yourself, do I understand the company? How does it make money? Does it have a real product or service? Would I still want to own it if the price dropped tomorrow? If you cannot explain why you want to own a stock, you may be investing based on excitement instead of understanding. Charlie Munger, Warren Buffett's longtime investing partner, once said, knowing what you don't know is more useful than being brilliant. In other words, admitting that an investment is too complicated can protect you from making an expensive mistake. Step 2. Start with diversification. Instead of putting all your money into one company, many beginners choose a diversified global index fund. This spreads the investment across many companies and countries, reducing the impact of one company performing badly. Diversification does not remove risk. Your investment can still lose value, but it can be a more balanced starting point than betting everything on a single stock. Step 3. Invest regularly. Trying to predict the perfect day to invest is extremely difficult. A simpler approach is investing a manageable amount regularly, such as once a month. This can help you build a habit and avoid making emotional decisions based on short-term market movements. The goal is not to become rich overnight. The goal is to give your money time to grow while continuing to learn. Step 4. Expect the market to fall. The stock market will not go up every day. Prices can fall because of economic news, company problems, fear, or events nobody expected. When this happens, do not automatically panic. Go back to your original plan and ask whether the long-term reason for investing has actually changed. Warren Buffett once wrote, "We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." This does not mean blindly buying every stock during a crash. It means avoiding emotional decisions and thinking independently when fear takes over. Step 5. Learn before you go deeper. Start by learning the basics: revenue and profit, debt and cash flow, valuation, diversification, risk and time horizon. If you enjoy researching companies, you can gradually explore individual stocks, but you do not need complicated investments to become a disciplined investor. Munger also emphasized the value of patience. His investing philosophy focused on finding a few strong opportunities and waiting instead of constantly buying and selling. Step 6. Think in years, not days. The stock market is not a guaranteed money-making machine. Some investments lose money, and past performance does not guarantee future results. But with a diversified strategy, regular contributions, patience, and continuous learning, you create a more structured way to participate in the market. So remember, do not chase hype. Do not invest money you cannot afford to lose. Do not panic because of one bad day. Start small, stay consistent, and keep learning. The most important question is not, which stock will make me rich tomorrow? It is, what investing strategy can I follow for the next 10 years? Start with what you understand. Avoid what you do not understand. Give your strategy time to work. This video is for educational purposes only and is not financial advice. Investments involve risk, and returns are never guaranteed. But there is one more part of investing that many beginners overlook: your behavior. You can have a good investment plan and still hurt your results by constantly changing it. When prices rise, you may feel confident. When the market falls, scary headlines can make you want to sell immediately. That is why it helps to create a plan before investing. Decide how much you can invest, how long you can leave the money invested, and how you would react if the market dropped by 20%. Making these decisions in advance can help you avoid emotional choices later. Your time horizon matters. If you need the money soon, investing heavily in stocks may expose you to too much short-term risk. You might be forced to sell during a market decline. For long-term goals, you may have more time to handle temporary ups and downs, but losses are never impossible. It is also wise to build an emergency fund before taking significant investment risk. Unexpected expenses should not force you to sell your investments at the worst possible time. Next, pay attention to fees. Two similar funds can have very different costs. Even a small annual fee can reduce the amount of money that stays invested and grows over many years. Always check expense ratios, account fees, and trading costs before investing. Diversification matters too. Owning several companies from the same industry may not be enough, because they could all fall for the same reason. A broad fund can spread your money across many companies, sectors, and countries. Diversification cannot guarantee profits, but it can reduce the impact of one investment performing badly. Before buying an individual stock, ask, What does this company do? How does it make money? Are its sales and profits growing? Does it have too much debt? What could go wrong? Why am I buying it? If your only answer is, everyone online says it will go up, stop and do more research. Popularity is not the same as quality. Also remember the difference between investing and speculation. Investing focuses on owning something you believe can create value over time. Speculation focuses more on short-term price movements and hoping someone else will pay more later. Compound growth can become more powerful when returns remain invested. This is why starting with a manageable amount and staying consistent may matter more than waiting until you have a large amount of money. But compound growth does not guarantee a profit, and historical returns do not predict the future. Charlie Munger said, "Knowing what you don't know is more useful than being brilliant." You do not need to know everything before you start learning, but you should be honest about what you do not understand. So remember, start with a goal. Choose investments you understand. Diversify where appropriate. Keep fees under control. Invest according to your time horizon. Stay patient and keep learning. Start small. Stay curious. Think long term. Like and subscribe for more.